Hey guys, welcome to Joy of the Trade. There's so much to discuss in the stock market right now. I don't even know where to begin. Actually, I kind of do, but I'll get there in a minute. We've had such a mega bullish risk on atmosphere to begin 2023, which leaves me a little bit suspicious, but I'll get to that in a second. What's happened basically since the light switch turned on in 2023 is the buyer stepped in abroad first. We saw buying in Asia. Let me show you. Let me share my screen. I'll show you what I'm looking at. You can see it for yourselves. So what I'm showing you here is worldwide equity indices, and Hong Kong, Asia has just led the way straight out of the gates. The whole China reopening, this tone that they're taking, that they're more pro-business now and they want people to live life, etc. Stocks are up 10% in Hong Kong. And then you saw Europe follow in lockstep. And so Europe is interesting because if we take a look underneath the hood here at this Euro stocks, come on, Bloomberg, don't fail me now. If we look at the Euro stocks, you're going to see that you have a lot of beat down stocks that are a major component in why this index has done so well. So if we look at the best performing stocks in Europe, it's going to give us an idea. You're going to see ASML, you're going to see Bayer, you're going to see Adidas. They have these big old legacy brands that have done really well. But you're also going to see, if they let me get this groups, if I can see the groups in the Euro stocks, can't show you. But European banks have been on fire too, which is incredible because it's been one of the worst sectors that we have out there. Yeah, check this out. To give you an idea, and this is such a risk-on thing. Look at these Eurostox banks. Now you'll be saying to me, that is a super bullish chart. It is. But if you look back, if we scale back in time, these things, a lot of these names are so beat down, super beat down. Well, the US banks have done so much better. If we look at like the XLF, for instance, check this out, comparing European banks to American banks. American banks are above, are near highs, where these things are still so far down and have not recovered at all from the great financial crisis. But that's just one aspect of the component. So just an interesting thing that I wanted you guys to pay attention to. I'm bearish on banks. So how long is that bank rally going to last? I don't know. So that's the first chink in the armor of this rally and why I don't know how sustainable it's going to be. We also had this week, if we look back in time to the beginning of the week, we had the CPI, which came totally in line. And we had 6.5%. We had President Biden doing a victory lap because it's not 8.5% or 9%, it's 6.5%, which is still incredibly high. And it's fading though. It's starting to come off. But you have pockets of the consumer experience which are held, like buying eggs, etc. We had autos come down. So if we look at, you can look at subsectors here. This Bloomberg is such a beauty. She's so worth it, her weight in gold. Let me just flex on this Bloomberg for a minute. Let me do a Bloomberg flex, as my kids would say. Dad, you're flexing on them. So if we look at year over year increases in costs of food, look at this. White bread, 17.7%. Cookies, 18.2%. There's still inflation out there. All right, beef and veal down 3%. Pork up 1.5%. But you got hot dogs are still up 18%. Lord knows I love a good dog. Chicken up double digits, 10%. And if you go down even more, you're going to see eggs up 59%. 59%. It's a staple. Eggs are a staple in pretty much everybody's diet. So dairy up 21%. So the food aspect is interesting. But if we look at other items not food related, you're going to see another interesting thing that I noticed, and I'm going to show you how it's playing out on this Friday morning for us, because it's going to be something to pay attention to in your portfolios going forward. I think this is a sector to be a little bit scared of. If we go down, this is a little bit, bear with me, there's a lot of items here. Oh, don't go too fast. There we go. Vehicles. If we look at vehicles, they had a used, where's the used car? Used cars and trucks down 8.8%. Okay. Now, we had a parabolic move where we had used cars trading above brand new cars, which is a total market distortion, but it created a buying power. They had a pricing power. The auto companies had a pricing power. So this morning, we come into some fresh news of Tesla cutting. They were cutting prices. They're cutting prices. Now, this stock has been bouncing, it's been rebounding, but take a look at this stock of Ford, which has been an absolute ripper. Now, Ford should be a stock that gets a lot of love because of the performance of their electric truck, the Lightning, but stock was down 7%, like five and change at this point on that news. If used cars are plummeting, new cars are going to have to bring the prices lower too. And there goes the margin. There goes a lot of this love story. And we're heading into a recession. So the moral of the story, guys, is this is going to be a choppy year. It's going to be a difficult tape. It's not going to be a one-way street up, in my opinion. And we're going off of the inflation story, which had its goodwill and run its course. And we're getting into earnings. We're getting into real life earnings. We're getting back to a stock pickers market, a stock traders market, where fundamental news that stocks release are going to move stocks and they're going to matter. I think you saw your last really important CPI report this month, unless we have a big shock surprise move one way or the other. I think you're going to be much more focused on individual stocks, earnings, and bigger global macro things like rates and oil and things like that. But if you like this video, like it on crushtheopen.com, join Joy of the Trade. I have a lot of stuff coming next week with my boy Lance. We're going to be active in this earnings market. So LFG guys, have a great weekend.